Hi everyone, welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX VettaFi. Is the current market fueled by genuine growth, or is it a house of cards built on borrowed money? Today, we're looking at margin debt, the money investors borrow from brokers to buy more stocks. It's a double-edged sword. It supercharges your gains on the way up, but it can trigger a margin call nightmare on the way down. Let's dive into the latest data through February 2026 to see where we stand. Look at this chart. We've adjusted these numbers for inflation to give us the real value. Historically, margin debt and the S&P 500 have shown a strong correlation. But notice the peaks. In 2000, margin debt peaked right as the tech bubble burst. In 2007, it peaked just 3 months before the Great Financial Crisis. Fast forward to today. Following a 10-month surge, margin debt finally declined in February, falling 2% to $1.25 trillion. This marks the first sign of a slowdown in borrowing since last year. To make the risk clearer, let's flip the debt line. When that purple line drops sharply, it indicates a massive increase in leverage. When it shoots back up, that's deleveraging, or forced selling, which usually happens during a market crash. Look at the current divergence. We're sitting at a historic extreme. When the lines move further away from each other, investors are borrowing aggressively. The current gap between what people own and what they owe has rarely been this wide. When we compare the growth rates since 1997, a significant divergence appears. While the S&P 500 has grown a massive 326% in real terms, margin debt has climbed nearly 500%. In the last few months, debt has outpaced market growth at a rapid clip, suggesting that recent market highs are increasingly reliant on borrowed capital rather than organic growth. And if this debt is concentrated in a few high-performing AI tech stocks, the entire market becomes sensitive to the volatility of just a few companies. We call this overextension. And historically, when debt outpaces the market at this rate, the risk of a sharp reversal increases. Now let's take a look at the net credit balance. This is the cash investors have minus the debt that they owe. When the chart is red, investors are in the hole. Right now, we're at a staggering negative $848 billion. This is near a record low and means the safety net is almost non-existent. In a high interest rate environment, the cost of carrying this $1.25 trillion in debt is substantial. Unlike the low rate environment of 2021, today's investors are under constant pressure to see immediate gains just to offset their interest expenses. Timing is everything though. Troughs in credit balance usually precede market peaks. In 2000, we had a 6-month warning. In 2007, it was 4 months. In 2021, 2 months. But look at 2025 and early 2026. That lead time has narrowed to 0 months. The market and debt are peaking simultaneously. When the lead time disappears like this, it suggests the market has become highly vulnerable, as the exit door for investors trying to get out at the top has become much smaller. While margin debt isn't a perfect crystal ball, we are officially in the caution zone, and we'll certainly keep a close eye on this indicator as we move further into 2026. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.